Linda with Tax TV, here with some valuable tax information for investors. While taxes are said to be as certain as death, the stock markets, on the other hand, are as tumultuous as high seas. Here, we'll cover some basic tax tips that may help with the constant ups and downs of investing. First, evaluate your portfolio before the end of the year. Do you have big losers in there? It might make sense to sell stocks with losses to help offset some of your capital gains income. While the rules for calculating these gains and losses can get tricky, in general, capital gains offset capital losses. This highlights an important point about investments. You control the timing. Stocks, bonds, and mutual funds are all capital assets the IRS does not tax until you sell them or dispose of them in some other taxable transaction. Second, dividends earned during the year must be reported as income. You'll get a Form 1099 div from your mutual fund or broker showing how much you received and what part, if any, represents qualified dividends. That's an important distinction because qualified dividends are taxed at a lower rate. Lastly, investors may want to consider making charitable contributions with appreciated securities instead of cash. When you donate appreciated securities, you can take a deduction for the current value of the stock, and the charity takes the stock with a basis equal to the current value. This way, you and the charity avoid paying taxes on any past gain. Don't forget, investors can generally deduct the expenses of producing taxable investment income if they itemize on their return. These include expenses for investment counseling and advice, legal and accounting fees, and investment newsletters. To invest in some more tax tips, search taxtv.com.